Hey, I want to say thank you so much for joining us for the renting to owning so that we can just provide a simple roadmap for first time home buyers. One of the things that I am passionate about is helping make sure you understand and can navigate the process with clarity and confidence, because I believe that those two things, understanding and clarity, breed confidence. And so it's important to me. And so, again, thanks so much for taking the time out of your busy schedule and busy life to join us for this. I'm Travis Jenkins. I'm the branch manager at Wheatland Mortgage, and really excited to help and assist you through this process. So we're going to dive right in. This will not be a lengthy video. We're going to cover it pretty quickly. But I just want to give you some really clear understanding from the I don't know, 30,000 foot view of what this process looks like and how it works. So as we dive through these, there'll be slides, and then in the recording afterwards, it should have subtitles as well so that you can watch that. So here we go. Let's talk about how much can you afford. Okay, how much can you afford? If you go on my website, it's going to be able to give you a calculator, travisjenkinshomeloans.com. There at the top, there is an option to where you can choose to say, okay, here's what I make, you choose the calculators and the affordability one, and you'll input some information there. But there's some basic information you need to know, and that's what's reporting on your credit report. So think credit cards, think your student loans, think car payments, think anything that is happening on your that you had to apply for that's hitting your credit report. Okay, so that's the thing that you have to make sure that you're viewing and that you know what those numbers are, because that's what's going to help you know how to navigate through this process. Okay, so know what those things are. But what doesn't count in that calculation is your I don't know, your cell phone bill, think your any other payments like that. Your utilities don't count. That kind of item don't count towards your debt to income ratio, because that's what ultimately you're coming up with, is getting an idea of what that is. Okay. So credit report items go into calculating the debt to income, but let's first of all answer the question of what is debt to income. Okay, so debt to income is broken up into two sides when it comes to mortgages: the front and the back. The front side is 100% just the housing expense. Okay, so think of it like this: think of it in the terms of the housing expense is made up of your principal and interest. So if you take your total loan amount, say $100,000 is the loan amount, you would take the $100,000 times your whatever your interest rate is. For round numbers, let's say it's 6%. Broken down, that's what goes into calculating principal and interest. Then also, in every mortgage program for first-time home buyers, whether it's FHA, conventional, VA, USDA, any loan program, the only one you can avoid including property taxes and homeowners insurance is on conventional loans. If you have more than 20% equity, so you put more than 20% down in it, then you can waive the escrows. So in this situation, the housing expense includes your property taxes, and it includes your homeowners insurance, and it includes your private mortgage insurance if you're having to pay that. Property taxes are unique to that property, your municipality, the county that you live in. For instance, if you're in Canadian County, which is Yukon, Mustang, Western Oklahoma City, El Reno, it varies by, are you in Mustang schools, Yukon schools, or El Reno schools? Okay, like each of those is going to have a different, it's based on the house, it's based on the property, it's based on the location. All of those things play into that to help you determine what that is. Okay, so it varies property to property. You can cheat and look on, like if there's a house you're looking at specifically, go to Zillow, as long as it's not a new build, scroll to the very bottom, and you can see last year's property taxes. Okay, that'll give you a generalized idea of what that looks like. Okay, it won't be accurate for this year because every year property taxes go up. They typically appreciate about 3 to 5%. Then your homeowner's insurance, that's going to be uniquely based to you. The reason it's uniquely based to you is because it has to do with your history, right? Are you somebody who habitually files car claims? Oops, somebody bumped into me, I have to have this fixed. I get it, accidents happen, but if you're at fault and the insurance is paying for it, that's a claim. Those claims are absolutely going to impact what your cost is. Okay. So make sure that you are being a good steward with what those claims cost. Okay. So with that being said, that goes into calculating what that is. So those two pieces, principal interest, are going to stay the same on a fixed rate mortgage. That's what goes into this. Property taxes on homeowners insurance, they may adjust, but all of them, all five pieces of that, principal interest, homeowners insurance, property taxes, and private mortgage insurance, go into the housing expense. Then you've got the back end. So front, back. I don't know what's wrong with my light, but it's flickering at me. Front and back. All right. So front and backside is your housing expense, right? So it's your entire housing expense again. So all of this plus all other obligations. Think credit cards, student loans, car payments, child support, alimony. Those two may not be reporting on your credit report, but they are something you're obligated to pay. Therefore, we have to calculate it in. Okay. Student loans, maybe you say, wait. My student loans are deferred. I don't make a payment. That's great. However, we have to calculate a payment. We still have to treat it as though you are making a payment on those, because it does matter. It absolutely does make a difference. And so in order for us to make sure that you are that's being assessed correctly, we're obligated to make sure that is transpiring. Okay, so there's a calculation that we use, that's a certain percentage that goes into that to assess for it, because you do have to make the payment. You can never get away from it. You can't file for whatever it is, bankruptcy, and avoid paying those, right? You're still gonna have to pay them. You can't get out of paying student loans because the government lent you the money. They're gonna make sure you pay it. All right. So that's how we calculate the debt to income ratio. So that comes back to how much can I afford? Well, what debt to income ratio we ultimately use is determined by the loan program. For instance, FHA loans, which are most common for first-time home buyers, have a maximum calculation that allows for 45% on the front, 57% on the back. Well, how does that get calculated? First of all, let's take, for round number's sake, because of ease of it translating, if you made $10,000 a month gross income, we don't look at your net, we look at the gross. Okay. The gross income, if you made $10,000 a month, you could have up to a $4,500 a month expense on your housing expense, and $5,700 a month in obligations in total. That's a lot of money. I don't think that that's a great idea. I'm not saying you can't. I'm just telling you, I don't think it's a good idea. So with that being said, 45, typically we try to keep your FHA mortgages to no more than 41% on the front. The lower, the better, quite honestly. And about, at most, 54 is what we like, because it gives us some wiggle room. Then there's also a trade-off that it could get lower depending on if we're using a down payment assistance program, or if something in your credit history causes the automated system that does some initial underwriting nationwide on every one of those loans, exactly the same. There could be a possibility that it forces us into a manual underwrite, which again brings those ratios even lower. So FHA, most commonly used, just has some caveats. Then conventional loans, maximum of 40 and 50, 40 on the front, 50 on the back. USDA, I'll come back to VA momentarily. USDA, if you're in a rural area and you meet the household income qualifications, that would be 29 over 41. Okay, so 29% on the front, 41 on the back. But then let's talk about VA. VA, technically speaking, there's none, but every lender will have an overlay for a maximum. Okay, so for us, that maximum is 65% on the backside. Then it's up to the automated underwriting system to tell us what we can or cannot do. Every loan goes through the automated underwriting system. An automated underwriting system is looking at a couple of things. It's looking at your debt to income ratio, but then it's also looking at your credit score. Okay. It's looking at your income, job history, that kind of stuff. But DTI and credit score have the biggest impact to it. Okay. Your credit score is impacted by your repayment history. Are you somebody who pays your bills on time, or do we sometimes get behind? Is there more month than there is money and we got behind? I get it. Life happens. However, that impacts your credit score. The usage of your revolving credit lines, think credit cards. If you are using more than 30% of your revolving credit, that's a problem for your credit score. It's not a problem that you can't make the payment, But more than 30% is going to cause your credit score to go down. It's going to look at your length of credit history. Okay, so if we just don't have a long time of using our credit report, using our credit that's available to us, then it's going to go, we're not really sure what this person is going to do or is not going to do, but that plays into it. Then negatively, absolute negative impacts would be collections or charge-offs. Okay, so if something is reporting in collections or if something is reporting as a charge-off, it's been sent to collections because we didn't make the payment for a long period of time. Happens. Then that plays into it. Okay, and then if it's charged off, it changes the way we have to deal with it. Okay, so those go into effect. Those hurt you. Or if you have late payments, oops, there was more month than money. I missed that payment. I forgot to make it, whatever the case may be. And we have a 30-day late, that affects it. 30, 60, 90-day late absolutely will bring your score down. Now, if you're somebody who, man, we've had some issues in life has hit us and we've had more than a few late payments, then the best thing for you to do at this juncture is let's start getting you connected with somebody who does credit repair. We have a gentleman that we refer to at True Credit Consulting. His name is Jalen Couch. Love and adore the man to death. He's really good at what he does. He's helped numerous of my clients get their score recovered to the point that they are able to buy a house. He's able to navigate that and help us through that. I apologize. Just got an urgent message on a loan that's getting ready to close. So that's one of the things that happens. And so Jalen can help us to navigate that and know what to do next. Now, one of the things that's really good for monitoring your credit report is Credit Karma. However, Credit Karma is not the same as a mortgage credit inquiry. When it comes to credit scores, they're built on two different systems. Okay, there's the Vantage scoring system. That's what Credit Karma and other credit card systems use. That's what the automobile industry uses for their credit inquiries. And then there's the mortgage industry that uses the old FICO system. The old FICO system is the lowest level score that you can get. It's the harshest treatment of your credit history. The lightest one is what Credit Karma measures. Okay, so you've got the disparity between the two, and it's typically about 20 points in difference. 20, 25 on average is what we see, that your score is lower from Credit Karma to what we're going to see on a mortgage credit inquiry. The difference is Vantage scoring system, versus FICO. That's the main things that we see different. Okay, but your credit report, your credit score is a huge part of what you are able to afford. So it's important that you take care of that. And if you need help getting your score boosted because of what you already know is there, then let me get you in touch with Jalen. Or if you know somebody or there's somebody you've been referred to, we just need to get to work with somebody who can help us get our credit score recovered so we're able to begin to make a difference and begin to purchase a property. Okay, so that's how we determine what we can afford, is by taking a look at, here's how much money I make. I can afford to spend up to, let's say, 40% of what my gross income is every month on a mortgage payment. That's what you can be approved for. It doesn't mean that's what you can afford. To me, the difference in what I can afford and what I can be approved for is wildly different. I'm looking for a peace number. What am I at peace with? I can make that payment, as opposed to that's what the bank told me I can afford to pay. They're not the same. Live within your peace number. Then let's get you approved for what that house is. Then we can start that process, okay? So then we've got your credit score. We've talked about debt to income ratio. Now let's talk about the truth about down payment options. How do we come up with, and this plays into what you can afford, because what you can come up with for your down payment directly impacts that, okay? Because your down payment has to come from one of three sources. Either it has to be your own money. Hey, Travis, I've got $25,000 in the bank that I've been saving for my down payment. That's great. It can be gift funds. Secondly, gift funds can come from an immediate family member. So mom, dad, grandparents, aunt, uncle, something like that. It has to be immediate family. Sometimes an employer can do it, or it can come from an assistance program. Think of the Oklahoma Housing Finance Authority or agency, OFA. We do a lot of those loans because they give a great interest rate to go with it. But those are the three places that your down payment can come from. The down payment is going to be driven, how much it is driven by which loan program. FHA loans require a 3.5% down payment. 3.5. So a $200,000 purchase requires a $7,000 down payment on an FHA loan. On a first-time home buyer conventional loan, it requires $6,000. VA, $0. USDA, $0. But it's driven by which loan program that determines that. Okay, so on average, your closing costs, and we're going to cover this a lot in the next one. Your funds to close is built on the down payments, built on the closing costs. Your closing costs on average are going to run about, for a $250,000 purchase, somewhere in the 3 to 4% range is typically what we see, just to give you a ballpark. But it is uniquely dependent upon your history, your insurance costs, the property taxes, all of those pieces go into play with it. Okay, so that's what when we talk about your down payment, that's what it is. Now let's talk about the truth about real cost of buying a home. What are the real costs of buying a home? Well, number one, there's the funds to close. Funds to close stands on two legs. It stands on the down payment and it stands on the closing costs. The down payment, closing costs. Those two things are separate. Down payment, again, we just talked about, can be your money, gift funds, or a program, one of those three. But then you've got your closing costs. Closing costs are made up of really four different sections. Four different sections. I know I have three on here. I failed to put it on here. Just an oversight, slip of the mind. Okay, the first set of fees that we should be very honest about are the lender associated fees. Not every lender is the same in what their fees are. Okay, we charge two fees: underwriting and processing. It's the fees that we charge. Other companies charge differently. I'm not disparaging anybody, but everybody makes their choice. You could have an array of fees from origination, processing, underwriting, technology, doc preparation. Like everybody handles it a little bit differently in their business model. We charge two: underwriting and processing, and that's it. So then you've got lender fees and you've got title fees. Title fees are like, here we have to register this, we have to file the deed, we have to actually record it, it's the term. We have to record it with the county assessor that you are now the owner of record, and that goes into the abstracting and that goes into the whole process. Okay, so those fees are a group because an attorney has to get involved. There's preparation, there's docs that have to be legally prepared, and they go through hundreds and hundreds of pages per file. That have to get printed and then scanned back in and then registered, and the whole piece has to be done that way. So there's a lot of fees that they incur with that. So you've got your title fees. Then we have to set up an escrow account. Okay, so we've talked about your title fees, and now your escrow account. Your escrow account is made up of basically, think of it like this: it's a forced savings account. That forced savings account is going to be where you are put in a position to, the lender is going to save your annual payment amount for your homeowner's insurance and your property taxes, because they're going to make the payment. They're going to make sure that those two things don't cause the loan to go bad. Okay, so as they're dealing with that, those two things come into play. Number one, they're going to you're also in this, you're with the escrow, you've got your prepaids. Okay, the prepaids and the escrow kind of go together because you pay your first year, you prepay your first full year of coverage for your homeowner's insurance. Then you put 3 months worth of your homeowner's insurance escrow amount. So if your homeowner's insurance is $1,200 a year, then you're going to have 3 months of that, so $360 that goes into your escrow account at closing to fund it. Okay, to get it started and give it a cushion. Then every month, $100 or 1/12 of the total is put into that escrow account every month as a deposit, saved for you at the lender, and then they're going to make that payment out of the escrow account every year for your homeowner's insurance and for your property taxes. Those two things coincide. So those four things make up the total of the closing costs paired with your down payment, come together for your funds to close. Okay, so that all happens at closing. Before closing, you're also going to incur a homeowner's inspection. Your realtor's going to have a referral for you on who they want you to use for this or recommend for you to use for this. If you don't like them, or you want to look for somebody else, or you want a different recommendation to also have a conversation with, let me know. We have a list of people that we would love to connect you with. But those people are going to inspect the house and make sure it's all in good shape. It's got good bones. All the pieces are there. If there's any other things that they recommend that you get taken care of, they're going to talk about that. That's separate from the appraisal. The inspection, home inspection, is not a mortgage required event. The appraisal is 100% mortgage required. It's what determines the value that's given to the home. Okay. So the appraisal sets the value and says, yes, this is what it's actually worth based on comps in the area, based on the shape of the home. And there are also going to be certain things that it's going to require. The appraiser's going to say, no, 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 this house can't be sold until that is fixed. Okay. So for FHA loans, for instance, you cannot have chipped or peeling paint on the exterior of the house. It has to be addressed, has to be taken care of. It has to be scraped, sanded, and repainted. Doors, exterior doors, all around the house. You have to have working toilets and showers. You have to have floor covering. It could be tile. It could be stained or painted concrete, but it can't be just barren exposed concrete. All of those things have to be taken care of. There's a whole list of them, and every loan program has its own unique list. You pay the inspector outside of closing, not a loan cost. You pay the appraiser outside of closing. The reason we pay the appraiser outside of closing is because with the appraiser, you have to pay him regardless of whether or not you close with the transaction. If you don't close on the transaction, he still gets paid because he did his job. And that's the way that it should be. So this is the real cost of buying a house: the funds to close, the inspection, and the appraisal. What's negotiable? Okay, you can negotiate for what are called seller concessions. Seller paid closing costs is the technical term for us. Seller concessions can be used to cover any of this: the closing costs, anything that's associated with the closing costs, and the appraisal. It can never be used to cover the down payment. The down payment can come from one of three places: you, a gift from a family member, or an assistance program. Only three places the down payment can come from. That's it. Okay. So you've got your funds to close. The closing costs and the appraisal could be covered or negotiated to be covered by your closing costs. That's it. Okay. So then let's talk about rent versus owning in today's market based on what it is you want to do. Okay. So think of it like this. Okay. You've got long-term. Here's the three things that you need to think about determining if it's time to stay as a renter or if it's time to become an owner. What are your long-term goals? Long-term goals, I think of like this: 10 years from now, I want to fill in the blank. 10 years from now, I want to own my own home. I want to have a family. We're a family. I'm planning to get married, planning to have 2 kids, planning to whatever. This is where I'm wanting to go. Okay. So those are long-term goals. If your long-term goal is to kind of stay where you're at, you're settling in, then maybe it's time to transition from home renting to owning. Perhaps it's more tied up in your short-term goals. In the next 2 years, this is what we want. We're going to finish school. It's going to make more sense to stay as a renter now until we can get done with that, whatever. But think of it through your short-term goals. In the next 2 years, here's what we're trying to accomplish. And then lastly, what are your current plans in place? Okay. So if you're saving money, if you're putting money away, if you're going to be ready in the next 2, 3, 5, 6 months, year, 2 years, what are you doing to get there? Plans in place. I think of like this: am I saving money for my funds to close? Am I taking care of my credit usage? How's my credit score looking? Am I taking care of writing my own history in that regard? What am I doing to be ready to buy my house? Those three things: what are my long-term goals, short-term goals, and what current plans do I have in place that help me get there? Because then you can really make an educated decision on if home ownership is what is next. If it is, then when we start to look for houses, we want to start to look at location, proximity to work or schools or amenities, right? So if we're just we're getting married, we don't plan to have kids for 5 years phase, then you're 10 years away from it mattering what school you're living near in order to put your kids in the school you want. That may determine and decide which house you buy now. Let's think about needs versus wants. Okay. Prioritize your layout over paint colors. For instance, the house we live in, the house we bought, We bought a house that had more square footage. It was a little bit older, and we were going to put a little bit of work into. We did it that way because it gave us the space that we needed for everyone that lives under my roof. It was a choice based on what we needed, so we prioritized the layout over the colors, and we've made lots of changes. Then think of the 80-20 rule, okay? If it's 80% perfect, then you know what? It's a great find. If it's 80% perfect, it's a great find. You're never going to get 100% perfect because you know what? You didn't build it, and you, my friends, are like me, and you live there, and there's constantly going to be change you're wanting to make. Lastly, think of the resale value. Okay, if you buy an older home like we did, if you're going to resell it and continue to increase in value, be easy to sell, it's going to require you to put some sweat equity or work into it. That's okay. Just be prepared that that's coming. All right. So be thinking of what those things are because they absolutely go into it. Now, let's talk about a step-by-step timeline. How do we get there? What does it look like? Okay, number one, your pre-approval. Pre-approval, pre-qualification, various lenders call it different things. In the pre-approval process, that starts with you getting set up with a lender, okay? If you're with me, let's say that that's the case, and you say, Travis, we're ready. Let's start the process. You fill out the application. It should take no more than 48 hours for your entire pre-approval process to be completed. What that does is it helps us to settle on a piece number. That's conversations of, okay, hey, we can approve you for $500,000, but that $500,000 comes with a $4,500 payment. And you're going, wait, no, we want an $1,800 payment. Okay, great. Then we back it down and we get to, okay, if you want your payment to be this, then this is the house you can afford. Make sense? That's what I'm looking for. So we start there. Okay. Pre-approvals typically are good for 120 days. At least your credit report is. So from the time I pre-approve you, here you go. You got 90 days to get it under contract because it's going to take about 30 days to go from contract to close. All right. That's the truth on that time frame. All right. So that's about what we're looking for. Okay. Then, so pre-approvals first, then you go house hunting. Don't go house hunting first. That's like going to the grocery store when you're hungry. We're going to go to the grocery store and buy groceries for the week, and then we're going to go home and cook dinner. You know what you're going to do? You're going to spend way more money at the grocery store if you do it that way. Instead, get pre-approved so you have a realistic expectation of what you need and what you can afford. Start there, then go house hunting. House hunting could last 2 days, can last 2 years, depending on how picky you are. That's just simply the way that works. Then you've got the contract, okay? Contract is where you set your price. All right, we found the house, we made an offer, we're under contract. Okay, making an offer to contract could take 10 minutes, it could take 48 hours. It varies depending on how many times you go back and forth or how quickly that process works with the realtors and the sellers. You get a house under contract and you set your price and you set the contingency terms. We have to sell our own house first before we can buy the next one. There's different terms that you can negotiate there. That's a realtor question of what you do. So from contract to closing, 30 days. Contract to inspections, 5 days. You need to have those done in the first 5 days from the time everybody signs the contract. Contract to appraisal, we have to order the appraisal within 8 days from you, everybody signing the contract. Then the appraiser has 10 days to complete it. So contract to the appraisal has to be back into us 18 days. Then if it requires repairs, it'll be subject to reinspection. So then we have to let the seller know, hey, the appraiser says you have to make these repairs. Then we get it reinspected. Then the appraiser comes back out, they reinspect, gives it, yep, you're good, that house can be sold now. That part of the process can take us a little while, but we want the initial part of it done has to be done within 18 days to have it in place. Okay, this is where the bank confirms the home's market value and that is resellable. Contract to closing day, to where we sign the paperwork and it becomes yours and the keys are yours and you get to move in. For us, typically less than 30 days, we're ready to go for that. Are there extenuating circumstances at times? Yes. Love to tell you that every lender is going to meet closing day. I wish that was the case, just not true. Truth is, you should always know that that's coming, that it's a possibility. The minute that the lender knows there may be a problem with us reaching closing on time, and here's why. Okay, so that's how that process works. That's the step-by-step timeline. Now, let's talk about your team. Who is it that helps make the real estate transaction come to pass? There's four distinctly different groups here. Okay, I should have put me on top because you should start with me, and that's the way that it works because it's the truth. All right, number one on my team, there's myself, and then I have my loan partner. His name's Junior Jenkins. Yes, he's my father. My kids call him Pawpaw. He's amazing with people, and he's really good at customer service. Then there's Angela Blonsky. She's my processor. She's the best in the business. She's who helps me get your file from the time you're under contract till we get to the closing table. It's her responsibility to make sure every hoop is jumped through for the underwriter. That's her job. Okay, so that's one aspect of it. Secondly, you've got the title agent. Okay, the title agent is who is going to make sure that all of the abstracting is done, that you legally are going to own all of this, it's registered and done correctly. The title agent is a wildly important person to make sure all of those pieces are done correctly. Then you've got the home inspector as a part of the process. Home inspector is a really important piece to the puzzle because they're going to make sure that all of the other things that the appraiser doesn't necessarily require that you want negotiated to be done, get done. Lastly, not necessarily lastly because they're last, but just because in the order I started at the bottom and went up. Lastly is going to be your realtor, all right? The realtor is your expert negotiator and market guide. They're going to make sure you find the house that you want, they get you negotiated at the price that you can afford, and that they make all the pieces come together. It's an important part. The realtor, loan officer, tag team side of it is wildly important. If you're not already working with a realtor, I've got several that I would love to connect you with that I work with all the time that are amazing, absolutely amazing. I adore them, think the world of them, and they can help you navigate this and become a homeowner in an amazing fashion. Okay, so that's who handles all of the pieces to the puzzle. Now, once we get your dream team together, then let's start to go, okay, what's next? This is where you embrace the journey of homeownership. That's where you would start with, for us, the pre-qualification process. You fill out the application within 24 to 48 hours at most. You know what you can afford, what your payment's going to look like, what your interest rate's going to look like. Your interest rate won't be locked at that juncture. We don't lock it until we're within 30 days. So you have to get something under contract before we lock it. But you're going to know kind of where you qualify at. We're going to know if we need down payment assistance. Are we using OFA, or do we need to go with something else? We're going to have navigated all of those pieces to the puzzle to help us figure out what's next. That's where having the right dream team together helps make all of this happen. So if homeownership's next, then let's start the pre-qualification process and let's get you approved so that you know confidently what you can afford, so you can go find a house that meets all of your checklists, at least 8 out of 10, so that you know where you're at, what you're looking for, and what it looks like to become a homeowner. If you've got questions, please reach out to me. If you would like to schedule a new buyer new consultation, let me know. Love to set that up for you. You can get a lot of information off the website, travisjenkinshomeloans.com. And from there, you can start the process. You can apply, you can look at calculators, you can play with rates, so much information there that you can begin to navigate and make come to pass. So with that being said, my friends, thank you for joining us tonight. If you got any questions, stick around. I'll be happy to answer.